talk about this week, Stephen?
COVID and infrastructure.
Sort of picking up a theme that we've had with the infrastructure bill coming in, and when I think of our scheduled events, Rob, I have you as leading the Biden administration agenda event. Hopefully that's part of the infrastructure piece there.
We will follow that up along with the good Gibson Dunn DC lawyer. So thank you. So we'll follow some things up there.
Okay, great. So look, we just wanted to touch base on what we do. Many people are now coming in as we're looking at the calendar ahead. A lot of people, for those who don't know, this is sort of a community. This is very much a community where a lot of the things come up in ideas in this 10:30 to 11 o'clock session every week. And then they move themselves over here to the left of the on deck, like this Biden agenda. 5G looks like it's going to come along. You know what? I just realized, I don't know if Ilya Gertzberg is on. Ilya, are you still on?
Yes, hi, Mark.
I asked if I hit everybody. You didn't have a chance to speak. Well, maybe you could do two things. You could talk about the event we're planning together, and then your view on private credit. Ilya's sitting in Monaco, investing in all over the private credit space.
Thank you. Yes, indeed, we do direct private debt deals, typically in tandem with private debt funds. We're LP in some of those funds, but increasingly we participate in those deals as a non-LP. And we also try to partner up with family offices that have expertise in that. We have a global mandate, so I can talk about our experience, for example, participating in some of the deals in Asia, even a couple that we closed and exited in Africa. But generally speaking, it's North America and Eurozone. We typically do 5 to 7 deals in a given year. Things really came back fast in the deal space after a little bit of a break last year, COVID related. It's a two-sided coin. You certainly see a lot of capital chasing deals, which makes it hard for us to deliver on our target return target, which is in mid-teens. For senior deals, typically senior secured deals. But at the same time, it opens up good possibilities for exits, for refinancing. So you sort of know that at this point, there's always someone who can take you out. At the same time, rescue financing is also available if a company is not living up to its business plan. So, for example, in sectors like digital economy, cannabis, where there's a lot of equity capital available. So what the company can do is they can always raise capital underneath us. And that becomes a good way out. So it's a two-sided coin. We thought it might be good, Mark and I, to speak about this in depth. And we're thinking of doing a private credit event maybe a few weeks from now to offer some global perspective, to have some GPs speak, and as well as LP perspective. Personally, I've spoken with probably 200 managers in the space. I have an ongoing list of over 100 GPs that we like, and we probably saw deals from at least a third of those GPs, and I'm always keen to meet new managers, so anyone is welcome to exchange ideas about managers, and we can also do it in a more formal setting about a month from now.
Yeah, that's going to be a great one, and I look forward to doing that with you, Ilya. I also look forward to doing this in Monaco again. So that's where we'll make that one of our stops. Any, I guess we're some other people have joined a little wider. What we were just finishing up was our principals and institution sessions, really interesting. I think one of the things, I don't know if Brian Geiser's still on here, but one of the points takes away is looking for specialists. You don't hire, or you don't go to a lawyer or a doctor, you go straight to a specialist. And that's part of what his investing style. And that's part of what we're doing with having strategic advisors, as well as the funds we choose. So, and really that's part of the themes here, right? You're just trying to understand these specialty niches, whether it's private credit or, in Africa, I've got a colleague of mine who's been there for 10 years and just try to find those specialists. I think it's definitely a theme to carry on. Maybe a few other people on the event side, Anand, if you're still on, or if anyone else wants to speak up on the upcoming events, we have, next up is VC, actually India, Kiran Dutta's on. We have India next week, or the week after, I guess it is. It'd be nice to take 1 week off. Then we have VC, and that one, let's see if I've got that here. Pull it up. Yeah, here it is. VC. Who wants to? Is Tino? Are you in here? You want to speak up to the VC event? Or anybody else involved? I would have expected Tino to be here. But as you can see, Kim Colt is a very active investor, and Naval, the founder of AngelList, and Alain from Alumni Ventures. So I think it's going to be, I think venture is a tough space. Emotionally scarred, leave it to the experts, leave it to the funds, and then scratch your itch on those directs that they bring you. But we're going to have that debate. And then there's an impact theme as well on measuring, a lot of people, that's what Kim does. She invests into ventures that have impact.
I can add a few seconds on that if you want, because I was on the call.
Go for it.
Yes. So I think one of the most compelling things about that event is that there's a focus on a couple different things. One is micro VC, and the other is a fairly deep dive into impact, with the background theme being that impact can in fact be as profitable with the same types of returns or better than traditional VC, and there'll be a lot of points of view trying to support that thesis. So I thought that was very interesting, and also a lot of work around structured angel investing, on also kind of the full spectrum of investment from micro to a little bit higher magnitude investment, both on and off continent for us. So I just think it's going to be a really great program.
Thanks, John.
Hey, Mark.
Can I ask a question on impact?
Yeah. I'll get right back to you, Sherry. Go ahead, Zale.
So I've been doing a lot of research on UN SDGs, specifically around the details of them. They have the 17 SDGs, and each of the SDGs is broken down into some of the subcategories. In terms of impact, is that something anybody other than Zale and nerdy people like me care about?
So
Yes.
I'll show you, but everybody can speak up. Go ahead. Someone wants to speak up to that. I mean, if you look at our onboarding, we have an onboard for philanthropy, and you choose your SDGs that you're interested in. And I was going to go to it on the app, but that's, and I don't think we want to be limited, because sometimes those are nebulous. So we're allowing for everybody to sort of tag which ones they're interested in. And you'll notice when we onboard, that'll be the 5th pillar, is when you onboard the family office or your institution, strategic advisors, a fund, a deal, or a philanthropy. And we're going to interconnect them that way. But Sherry,
I'd like to put a plug into this really quick, Mark.
Of course.
This is Zach from Dubai.
I just love your picture again, Zach. I like the new picture.
Yeah, we updated it after our discussion. So just a quick plug on this. There's a new format we are experimenting with. It's called Show and Tell. So to your point, Zale, we want people to share the problem areas they care about, whether we have a foundation in it already or maybe a venture investment in it, so it's an impact. So that you come, you know, whether it's you or whoever you're invested in could present for like 15 minutes, for example, at any time that's fitting with the speaker, so that you share about this passion area you have. So it's a new format besides the usual format of having an event where we bring panelists. We want to focus the spotlight on the different, you know, SDGs you care about, or you know, philanthropy or impact work you've done. Plus the conference in March, which will have you know, focus on impact as well. There's still some spots there for speaking.
So just to be clear, I run a company, indoor vertical farming, and my approach was I help contribute to solving a certain number of SDGs. So I went through every one of the SDGs, and I have a long list, and then I did a Google search on this kind of stuff, and I found very little articles about people saying, oh, this is a great investment if you want to solve for this SDG. Or the other, water is big, which, you know, Mark is big on water, and this whole 361 is big on water. But so that's kind of where my question was coming from, is again, a little self-serving, but.
I think
I can say something to Zale, and on your point of vertical farming. If you want, for example, to make a session that will really be impactful, from what I've seen in this investment area, everyone's perspective on vertical farming is it's capex heavy, energy intensive. A lot of people, at least I know here in the GCC, they have projects like these as a pet project because they like the idea of having a farm, you know, because it used to be a desert. So think of the mindsets of the families here. So if you're in that industry and you care about these impact goals and SDGs, if you have a session that shows the latest in this area, you know, that it's improved than what it was 5 years ago with all the, you know, bankruptcy stories and vertical farm startups and all that, that'll be really impactful, I think.
Well, now you're playing in my hand, because that's ag tech. That's the next event on the 11th. And then there's a half that session is also going to bring in a cannabis ag tech. So I don't have the slide up on that, but that's coming together. Anon is helping to lead that. The other one is another cannabis. We had an international focus. Now we're going to bring in VC, private credit, private equity, everybody, all the asset classes on cannabis on the 16th. And then yeah, we have impact, which sort of plays back into this. And then we continue to do our briefings and your show tell. I'm almost thinking of calling it Philanthropies Connecting in a way, but sorry, actually, Sherry, you had a comment. Did I skip over you?
It's totally fine. Mark, you know me to be a liquids person, and we were talking about venture and your experience. You remember in 2015, I made a venture mistake, but what I wanted to tell everyone is that how I've been playing venture, if not, I think they are my favorite venture fund is HOF, H-O-F.
Yeah.
Right? And so, yeah, so it's Hisham Ansi Fadi. Ansi is Ansi Sarars of the Sarars family in Egypt. And these are a group of guys who are in their mid to late 20s, some early 30s. And I found that the way they play venture is really incredible. So because of their connections and their relationships, and I know you'll talk further about venture another time, and I'm hoping to join as well. But because my husband and I, between the two of our families, we're a mixture of Gen 3 wealth, Gen 2, Gen 1, and I've had very good experiences with other investors who are also multiple gens, as well as generating current wealth. So I can't, I highly recommend HOF for anyone who's looking at venture.
Yep. I have never done anything with them, but I've heard a lot of good things. And we should invite them. I think we should do a series of these. And
they would be great. Thank you.
Yep. Any other just back on the events calendar? Yeah, I know 5G. I can almost taste it. It's almost going on the calendar. Biden, we talked about private. We talked about Africa. Hearing an echo. FinTech will have a 4. I think it's definitely. We're going to have like venture 2, 3, 4, 5. Just like we're having virus 2, 3, 4, 5. I'm going to mute a few people. Anyone else for the good order? I know that actually Ron Diamond, we talked about, I've got you on here, the on deck. We just have to put it together. You may want to you want to talk about the theme you're going to touch on?
I got to figure it out first.
I thought you had it figured out.
No, we're basically I'm gonna be talking about, you know, how family offices they're starting to disrupt private equity, venture capital, and real estate. The problem is that a lot of these family offices are very inefficient, very fragmented, and very siloed. So you look at the big ones like the Pritzkers and the Crowns, the Dells, they can compete directly with Apollo and those firms. Most of these family offices, they've made their money selling Beanie Babies or Guess Jeans or Giorgio perfume or chain of gas stations, and they come into money. So they don't have the skill set. So what I'm doing now is, and one of the things we're touching on is at Stanford University, I'm putting together a global family office initiative where the goal is to help to professionalize and institutionalize family offices and then give the larger family office a way to network. Because I do think that, you know, like the private equity and venture capital disrupted the public markets in the early 80s. I do believe strongly that family offices will ultimately disrupt even more the venture capital and private equity world. And I just think it's because it's got patient capital, the alignment of interest is much better. And I also think that the private equity model and the venture capital world, in general, they've bastardized themselves and it's become an AUM game. And that's not a good alignment of interest. So those are some of the things we'll touch on.
Yeah, it's going to be great. Anyone else?
Hey, Mark, let me go back and ask a question of Todd, if I may. Todd, you know, interesting, you know, thoughts on the VC secondary, and perhaps tell me how do you think about that versus SPACs? Because even though it doesn't seem like there's an apparent overlap, it almost strikes me as, you know, kind of interesting spaces.
Well, in secondaries, you're not getting that immediate liquidity.
Right.
The seller is, and I you know, so that's different. I can see. I mean, it's an interesting question, Bill. There's some overlap there, but the economics are different.
Yeah. Yeah. No. So.
Well, we had a SPAC event. We could do probably time to do another one. One really interesting. One of my Russian friends, Ivan Tavrin, Kismet. He did his first deal. He didn't do a takeover. He took a smaller stake, brought in a pipe. He's done 2 more SPACs. I saw him buy 150 TV and radio stations and then partner with Disney in Russia, Disney Town. And I wouldn't be surprised if he's going to have Kismet 7, 8, 9, 10. And some of our people on this call are participating in SPAC, sponsor economics. But then again, somebody put up, was it you, Tom? Somebody put an article up, you know, that this is going to all implode. Is that yours or someone else?
Yeah, I posted that as a Harvard Business Review assessment of SPACs. You know.
What was the thesis there? I didn't get a chance to read it.
I'm sorry?
What was the thesis of why it's going to?
Oh yeah, I mean, well, I think there's some data there that suggested there's been very few real successes in the SPAC market, and you know, they're somewhat dubious in terms of kind of the long-term legitimacy of that as an investment vehicle. But you should read it. It's in the app. I posted it there.
Tom, Anders here. I mean, the other practical thing I think is, you know, people have invested in SPACs for years at a discount, and today you're buying them at a premium out the gates anyway. So I think most SPACs today you'll find trades above 100 well before we know what's going to happen to them. That's one of the issues I think that puts stress on it as well.
Yeah, I'll find your article. Here's the article. And you get a free bowl of soup or a beer, Tom, for saying the word app on my
What's that? What's that?
You get a free bowl of soup or a beer for saying, the app on our channel here. So I'm trying to get everybody to actually use it.
No, I guess
love
it's well
I
trained.
love the app. The app is awesome.
They get a glass of red wine. Everyone use the app.
There you go. All right. If you actually use it, I'll give you a bottle of wine.
Done.
This back bubble is about to burst, as you can all see. I'll throw it into the chat. Who else? Arnaud, I haven't had you on here for a bit. What are you interested in seeing?
Talking to me, I guess. Arnaud, you said, huh?
Yes.
So I stay quiet because I just joined. So for me, I'm new in the journey. So maybe I present myself. I work for Edmond Rothschild. It's a Swiss bank, a French-Swiss group, a well-known private name. So it's a privately owned company, and I sit on the board of the pension fund of the group, and do select external funds as well for the company. That's what I do. So pretty new at your event. So listening now, and I'm sure I'll be able to present something later on.
That's great. In due course. Thank you. You have Anderson heritage, right? If I remember. Arthur Anderson. Others with the perspective? Before we turn to, in 5 minutes, we're going to turn to Stephen Burke, and then we'll have a panel talk about other insights. But in this sort of town hall environment, Paul Kahn, by the way, you missed it. Todd Rupert's playing up GP-led secondaries.
Oh, who's that?
Todd Rupert.
All right, he gets a
Paul leads one.
I've got the same deal as you do, Mark. He gets a bottle of wine for that whenever you mention GP-led secondaries.
Okay, well then I'll just have you send Sarah, to Sherry the bottle.
Let's make it a California cab.
That's a deal.
I'm changing my presentation now.
Hey, Mark.
Yeah,
hey, this is Rich. Hey, so I guess one of the things that we're kind of focused on from a family perspective is you have these run-ups in asset appreciation, kind of this fervor around certain types of strategies, whether they're in crypto, whether they're in crypto mining, whether they're in real estate, commercial, whether they're in effectively SPACs or secondaries. I mean, you see this run-up constantly in a flood of capital going to those areas of execution for short duration periods of time. And one of the things that we've always kind of focused on, as a kind of a Bezosian kind of thought process is, it's not where the puck is going, it's where like the puck is always going to be, right? So what are the things that are kind of indelible? What are the things that are just like very consistent, thoughtful return profiles that are non-correlated, things that just continue to ebb and flow and throw off, 8 to 10% return profile and just compound, right? Instead of this constant chase. I'm not saying set it and forget it, because it's hard to do that. But I mean, I go back to Brian Geister's commentary about, creating an assortment or portfolio strategy around, specialization and finding strategies that deliver on that, as opposed to constantly just getting on this hamster wheel. Because I mean, a lot of the stuff that we're talking about here is, scatter plot. And I'm really kind of curious to where people have found the opportunity just to drive consistent, thoughtful returns without having to go find the next best thing.
You want to take that one up?
Yeah,
I can,
I'll dive in onto that. Where we've really sort of focused in on is global trade. So things like leasing containers or things like drayage. So, the backup at the port of Oakland or the port of Los Angeles is a huge moneymaker. And we don't think that's going away. So just storing your container at that port, right? LA is always going to be a big port, right? It's kind of an infrastructure play, but it's always there. No matter what happens with the economy, for the most part.
Yeah, Chris, I mean, I second it most. With the lens I frame your remark on, Rich, is, we find consistency when the manager or the investment activity looks more like an operational activity. It actually provides a functional utility. So in Chris' case, right, it's containers. If you provide that utility, then you're getting a operational return rather than price discovery. So there's a bunch out there, but to your point, you have to look under all the stones. It's not symmetrical, I guess.
Yeah, I mean, I think one of the things is, as you look at the aperture and the surface area for attack, right? There's just a lot of different things to go after that may or may not fit. And then you're really about execution risk as opposed to, kind of price sensitivity, right? Which requires a different level of due diligence, and then also a different level of discovery, right? So, and Anders, you and I have talked about this. So
yeah, it feels like if we continue this, we're just gonna cheer each other on to no end. But yeah, we're on the same page.
The violent agreement.
Yeah. Richard, I'll chime in. A lot of the research that I've done thus far, in trying to think about this fixed income alternative, some really interesting, managers with some very kind of low tech stuff, things like, cell phone property leasing, billboards, the property that billboards sit on, that type of thing. Real estate lending guys, but who have, it's like completely relationship based and highly geographically oriented, because they just know some builders, who need capital, and they have, repeat customers and things like that, just because the relationship is so thick. I've run into another unusual one where these guys lend to very large commercial banks, keeping them safe from Basel III limits. And, it's a really unusual, highly differentiated little niche that these guys find. And I think the plus side is that you can get some really great returns out of it. The downside is that they're very, very thin on capacity. And many of them are like a couple $100 million and really can't get, very large. But, if you can get some space with those guys and they have the discipline to stay small, then there's an opportunity, to do exactly what you've talked about and what I tried to illustrate.
Everyone, it's 11 o'clock. And we'll definitely, I think we'll touch on some of that as we do our private credit theme. You can dive into that. I was trying to mute that noise, Bill, but it's actually you. So I'm going to mute you, unfortunately. So look, it's been 50 some weeks. We've gotten together at 11 o'clock. Actually, I'm borrowing some of the weeks that we were on the road, but soon it'll be 52 weeks, and I'll celebrate that. But we've always been turning to Stephen Burke to give us a little kickoff at 11 o'clock, and then from there we move in a couple directions. And this time we're going to have an interesting panel discussion of some other voices, some from earlier this morning, and then some new ones about it. I usually say what scares or excites you. You might hit that theme, but just what specifically, what's the unique insight you might share. But first, our good friend Stephen, I'm going to stop sharing my screen. Are you ready?
Yes.
Good man.
But I'm without any new insights, so we'll have to save them for the people who speak later. See if I can get this thing to work here.
Old insights are good too, if they're still,
So I wanted to talk today just quickly on COVID and America's infrastructure problem, because it's going to be in the news, has been in the news, will continue to be in the news for some time. And we've talked in the past about the American Society of Civil Engineers report that they put out every 4 years. The next one will be out in 2 weeks. And as you can see, the benign neglect by the government to address our infrastructure problem has taken us from a cost to improve of 1.3 trillion in 2001 to a cost to improve of 4.6. We have a funding gap of about 2 trillion on that 4.6. And I suspect it's going to grow considerably, although it won't be all captured in the next report. But just look, in 19, we spent less than about 2.5% of GDP on infrastructure. We spend about 17% on healthcare in the United States. Our infrastructure spend much lower than it was in the 30s, and coming out of the financial crisis and the COVID crisis, I think we need to bump it up considerably, but the country has a lot of needs, and how do we pay for it all? And can Congress ever agree on how to spend $2 trillion effectively is another issue we're going to deal with. But we're at a point now where these needs are no longer postponable, and you're seeing that all over the country, whether it's the wildfires in California, the water tide levels in Florida, or the Texas problem we had last week. We're still way underfunded on our needs. And a large part of our infrastructure is based on user-generated revenues, and the lockdowns wiped out those revenues for many of them. So that adds to state and municipal budget problems, which have been hurting, although not as bad as everyone thought because of the sharpness of the rebound. But the demands and the related spending increases that they have are rising. And we're seeing it with schools, water treatment, energy, roads, airports, and bridges, to name a few. And I'm going to touch on a couple of these in more detail. But we really need to renew, modernize, and invest in our infrastructure to maintain our international competitiveness. And we're hurting in a lot of different areas. And you can see that in so many examples. But I'll start with airports. And this is from the American Society of Civil Engineers. So their solutions and their framing is theirs, not mine. But air travel declined at its worst to 95%. I think we're up to now we've had 20% of pre-COVID volumes, or 25%, and starting to move up. What is interesting about air travel, and we're going to talk about this later, is there's a lot of pent-up demand, and the 4 out of 5 business travelers would get on a plane if they could start traveling again, and 76% of leisure travelers are willing to start traveling again. So we're starting to see from very low levels a demand for it. We have to get the health issues squared away and the restrictions lifted. But airport revenue losses were estimated to be about $23.5 billion last year. We have big problems in terms of aging terminals, old technology, the choke points at hubs. If you go to some of the different hub airports around the country, you really see the problems. The CARES Act provided some help, $10 billion, but they're looking for another $10 billion from American Society of Civil Engineers. I think the airlines and airports are looking for a lot more. There is a cap that's federally imposed on passengers' facility charges that's been in place for a while. That probably needs to be lifted somewhat to start to pay for this. And the more we modernize the facilities, the better we can bring travel costs down. If you go to bridges, this has been a problem for some time. We have about 620,000 bridges in the United States. 1 in 9 is viewed to be structurally deficient. I joke that I only half joke, but when I drive over the bridges in New York area, I will speed. The faster I can get across, the less challenges I have or concerns I have. But these are real issues, and not to make light of it, the problems and loss of lives we've had in the United States around bridge problems is way too high. And at the current spend levels, it would take 50 years to fix them all. And they're supported by the national gas tax from the Highway Trust Fund, which has not been changed since Bill Clinton raised it in 1993. That's an area we have to fix. And remember, the Highway Trust Fund works on a gasoline charge per gallon. So if you have electric vehicles, they're not involved in paying for these needs. So we have to decide how we're going to fix the solvency of the Highway Trust Fund. We're going to have to really look at putting more relief to the State Department of Transportations to address this. Shifting to energy, what we saw last week was we have a big problem. The bill for Texas that I saw today is going to be about $50 billion from last week's costs. That's going to have to be passed on over probably a decade or more. We're going to have cost in 2 forms, probably higher user taxes and higher overall taxes. So the bill's going to come due for this, and we've lost jobs because of what we've had in COVID. So we're going to we lost 500,000 jobs due to COVID. So when you look at the problems and think about some of the problems that we've had in energy, and that should be actually energy infrastructure problems. The Paradise Fire in California was due to a hardware failure on a line that was 100 years old. That's 25 years past its useful life. We can't postpone these needs any longer. We have to modernize our electric grid. We have 3 really primary grids in the United States that are not well connected. So we have to figure out a better national grid system. We have to really focus on streamlining permitting processes, and particularly as it comes to new sources of energy for our energy needs. And we really have to get better collaboration and put restrictions on how long the government can delay infrastructure projects, because it's such a big need. Wastewater is another area. We've had a $12.5 billion shortfall for the utilities in terms of revenues. They suffered about a 20% average loss of revenue decline from commercial industrial users. Also, they have the problem that they had to restore services for delinquent payers and stop paying for people who aren't, not shutting down people who aren't paying. So that's another problem that the system has that we're going to have to deal with. This is a $271 billion problem for the current and future needs. We have a lot of plants, and we have a lot of new users coming on that are going to have to be connected to the plants. So we have real issues across the system that are going to require massive spend. As you can see from the Biden proposal, this is a relief. It's not stimulus, it's relief, than 1.9 trillion that they're proposing. And very little of it is going to go to solve the infrastructure problems. There is plans for a bigger bill coming later that could be upwards of $2 trillion. And there aren't many areas where I agree that we should be increasing spending considerably, but I think this is the one area that as a nation, we really have to get our act together on. The last number I saw for the global infrastructure shortfall or spending needs for the next couple of years was a McKinsey report that said we needed to be spending upwards of $57 trillion on global infrastructure to deal with the needs. And the US certainly has its own issues, but we have to redirect dollars here very quickly. So Mark, with that, I'll stop and turn it over back to you.
Okay, great. Any comments, questions on what Stephen presented? Such a upbeat presentation, Stephen.
If we fix it though, Mark, and this is the issue, productivity goes way up, our GDP goes up, and we're losing massive amounts of money every year. And when people were driving, the roads delays, all that was costing about households, I think it was $1.2 trillion was the estimate for a 5-year period. And it was costing corporations about $700 billion. So the cost of not doing stuff, not only in lives, but in economic value is significant. And we just have to get our act together here.
Yeah, I don't want to switch completely. Let's still take a couple questions before we move on to the panel. Anything on this subject Stephen brought up?
Hey, Steve.
Any comments on Boeing?
Steve, it's Rob. Quick question on infrastructure and airports. It just seems that air traffic's going to be, it's going to take a while, even with sort of vaccine and just the concept of, working virtually. What's your read there as to the how the policymakers and frankly the infrastructure owners, how are they approaching that dynamic?
Hold your thought, Stephen. I just wanted to comment. If I ever have a news organization, I'm hiring Rob Collarina. He is the fastest one to a quick question. I appreciate it. Go for it.
Rob, there's the best guesses are it's going to take about 2 to 3 years to get leisure travel back to where it was, and probably 5 years or more to get business travel back. I question whether business travel will ever return to pre-COVID levels, but I think leisure will, and we're very big believers in the pent-up demand for people to get out. I think personally, Mark and I were traveling quite a bit in the pre-COVID period together, and it's such a different dynamic of meetings. But I do think, similar to the way office space is going to be downsized and not return to similar levels that we had pre-COVID anytime soon, I think corporate travel will be the same, but I think it will get back to probably 75% or 80% of its previous levels. So then you have this time issue that I think you're addressing, which is how do you balance the time issue versus the spend?
Actually, it's the spend issue, because it would seem that proponents are going to be arguing for things like EV recharging stations and other type of areas, and putting that allocation towards that.
Well, that's the problem for government that they've always had, right? Is how do you solve for as many big problems as we have right now? And I think that what we've always been a proponent of is splitting the budget between a maintenance budget and an investment budget, and running the projects like the chargers through an investment budget where you can measure real rates of return, and think about the existing infrastructure maintenance to keep in a state of good repair as a maintenance budget, and split the two of them up. And if you did that, you can measure your success of your investments and feed the winners and choke off the losers a lot quicker. But there's so many special interests that that's where the frustration comes in. And I think that's where the problems come. On a different subject, but similar, related to how governments think about things, New York State has been trying to approve decriminalization of marijuana, and they were trying to figure out if they moved to legalization, how would they split the revenues up? And they stopped coming to a decision on it because they couldn't share the revenues that they don't have now. And I think that's the same thing with infrastructure. We're trying to do too many things with a maintenance budget and not enough with an investment budget. And we have to split the spend that way, so we focus on the highest priority projects.
Even a quick question, that was great. This is Rich Sobel. How would you compare the problem of underfunding in the United States versus Europe? And second, do you have any kind of expectations about what's going to happen to taxes under the Biden administration?
If the Treasury Secretary has her way, we'll spend a lot of money and we'll have to tax it to get there. I think it's going to be tough to raise taxes this year. But I think they're coming. And I saw something from Yellen yesterday that was interesting. She is targeting loopholes and as a way that they can make quicker hits without raising the tax rates, which will probably get approved faster. And the loopholes or carried interest was one of the ones that they raised. So I think they're going to look for areas that they can focus on knocking off elements of taxing the wealthy without having wealth taxes and the like go in. They will add taxes to everybody next year, I think they'll be phased in over a period of time. They may hit the wealthy this year too, but it'll be gradually put in.
Stephen, this is Steve Trakoff. As one former president once noted, there's no such thing as a shovel-ready project. Wouldn't it be better to just simply fund the states with the existing projects they have and accelerate what's on the books? Now, those are largely maintenance, and some of them are projects. But as far as new projects coming in, I would envision a split between state and federal.
That's a great comment. And one of the things, if you think about what the federal government can do and do better, they can be better at procurement than a lot of states could be on their own, and they can be good funders of the needs that we have. But states, there has to be a better balance between the federal government and the state and local municipalities to get the money to work. But there are things that the federal government should take the lead on, and that is broadband access and things like that that are more future projects that if you diffuse it too much on a state and local level, you won't achieve what you want to achieve. But there are a number of energy things that can be done more on a state level that would be much more effective. The grid system redo should probably be a combination of federal and state and local governments. But we have big projects that we have to decide which ones are the highest priority and what's the order. And I think that's where government fails on a pretty regular basis because there's no real plan.
That's the gateway so that I have a proper tunnel into New York. But we'll talk about that later. I want to switch gears to we've invited some other people to join us that have some perspectives, just asking them to offer a unique insight today. Tomorrow, by the way, we do the same thing. in with a focus on Asia. It starts at 8 a.m. and same bat channel here on the Zoom. And you've got a really great, actually, not just Asia, but we're including those in Asia, across Asia, as well as Africa and Europe. So having said that, let's switch back. And I want to maybe lead off with Ron Diamond. Ron sits in Chicago. He has done a number of things with family offices. He's been a great connector for us, and he has an initiative. He's the chairman of the, I'll probably butcher what the exact name is, Ron, but it's effectively what Stanford University's initiative towards family office. Maybe you could unbutcher what I just said and introduce yourself properly. Unless he's stage left. I don't see Ron Diamond. Well, then let's go on to, I did see Candace earlier, but she may have pulled off. So I'm just going to go to you, Todd. Oh, you are on. There you are, Candace.
Hi, guys. It's Candace Beaumont.
Hi. Welcome.
Thank you.
It's been a while. Last time you were, I think it was October. So curious what how you're seeing the world today.
So I mean, we've been actually fairly active lately in SPACs. We're starting a few SPACs currently. We're starting one general SPAC with leading CIOs and sovereign wealth funds, and then we're starting another SPAC that's a healthcare tech SPAC. So obviously there's a bit of a bubble in valuations, but we think if you have like kind of good management, you back a SPAC, that it's just a very interesting sector that's growing. So we've been fairly active there, and we think, with the vaccine coming out, hopefully overall the economy and everything looks like it's going to go back to normal. A lot of the risk factors that we were concerned about last year are probably being mitigated. So and then the family I'm chairman of, who's the number 6 billionaire in Central America, he's doing a lot of industrial. So he was doing industrial real estate before throughout Central America, and he's kind of growing that and doing more and more. So that's kind of where how we're seeing the world right now.
Interesting. And so when you say SPACs, you're acting as SPAC sponsor, or you're backing SPACs, or both?
So we're actually creating 2 of our own SPACs, and then we'll sponsor them as well. And so that's what we're currently doing. And so kind of like that. So I'm happy to tell you a little bit. So the first one is just other CIOs of sovereign wealth funds and family offices. So it's fairly global in nature. And the second one is a healthcare tech SPAC with a leading healthcare tech guy who has a lot of proprietary deal flow. So it's very focused niche. Obviously the focused niches are better because, it's a very crowded market in SPACs. I'm on the advisory board of one of the all-female SPACs as well that just is in the process right now too. And it's very crowded for deal flow. You're getting like 5 or 6 people bidding on the same companies, and you've got some companies going public, and they've got $1 million of revenue, and it's crazy. So I think there's a bit of a bubble in the market, and you've got to be really careful. And you've got to be really careful what you invest in, because a lot of these things, the values aren't going to be maintained 2 years from now, and there's going to be probably a third of the SPACs will fail. So I think the market is a bit frothy. Mm-hmm. So kind of like that.
Well, just let me open it up for Q&A for you. Anyone on the SPAC topic want to add anything more or ask questions?
Quick question. This is Keith Compton, and with regard to SPACs, I'm curious to hear what you're seeing on the ground with regard to PIPE financings. It seems from an outsider looking in that there's been an inordinate amount of activity on primary sponsorship, and those dollars, as we all know, have the ability to flee, which requires an immense amount of PIPE financing. And there's certainly plenty of rumors running around that some pipes are not getting filled, or 6 months from now there won't be enough capital chasing them to fill them. And I'm curious to hear what you're experiencing on that front.
Yeah, well, this is Todd. I could say that the the typical $10 share price, the actual amount of money that's available when the SPAC demerges it's down about 40%, because the hedge funds have all sold back and just kept the free warrant. So you're right that there is a scramble to get PIPE money, and with some of the deals looking a little dicey, many of the bigger players that would provide that are staying on the sidelines.
Isn't it T. Rosen Act? I've seen them many of these announcements.
Yeah, they have done some extraordinarily selective.
But Todd, I think that's reflective also of the price change for the primary sponsors, right? That it's been a great market for them just to carry and pick up that warrant, but not if it's no longer at a discount, right?
Well, I mean, if you can sell and maintain that, certainly. Though, I mean, the warrant's not. Yeah, it's free, right? If it doesn't go anywhere, it doesn't cost you anything, right? And so it's just an option on the upside.
Yeah, well, and as long as you buy it below 100, you're safely, situated. Once you buy it above, you're hoping that it won't go back down, I guess.
Yeah, well, you're buying in that $10 on the IPO, right? So you're not paying over market at all, and then you have the option to stick with the company or just put back the $10 and you maintain the warrant.
Right.
So maybe Todd, since you've got the floor, and Bill Deukler was asking about SPACs and venture, maybe you could switch gears and talk about venture, and I could stop sharing.
Yeah, Mark and Robin from Rafina Capital. Just a quick question for Candice before we move on. Just a sector question, really. We run a boutique corporate finance house in London and Amsterdam, but we've had a couple of SPACs hunting amongst our portfolio clients, and they seem to have a sort of B2C appetite amongst them. Is that common in terms of what's going on, or just peculiar to the approaches we've had?
Yeah, there's a lot of tech SPACs right now. So a lot of the venture guys, such as yourselves, are getting contacted for portfolio companies, and it's quite competitive. I mean, you can probably have 4 or 5 SPACs contacting you, and you can really negotiate. So the tide is really turning to the companies versus the SPAC and the SPAC investors. So I mean, you'll have a lot of leverage, and you could have multiple SPACs contacting you. And typically you can negotiate with the one that's the most strategic for your portfolio company. So what's happening now is a SPAC that's winning the bid is the one that has kind of strategic people on their board or on their advisory board that can be value added to the portfolio company after the IPO. And that's the one that management teams are going with. And then, as I think someone alluded to earlier on the PIPE market being frothy, there are some strong SPACs where they have a forward purchase agreement, and that's just like a lead investor that guarantees to, if the other hedge funds, as everyone knows, like a third of them, don't come through and they vote no for the deal. So when that happens, when you have a forward purchase agreement, basically it's more certainty that the transaction will move forward. So if you're looking at a number of SPACs, if you go with one that has a forward purchase agreement and a lead investor that is that guarantees that they won't have to go through a PIPE and it's faster to close as well. So they're just some things to look at when you're the company and you're looking at different SPACs.
Thank you.
Mark, I got a quick question, if I may.
Yep. Hi, Akshay.
Hi.
You just sent me a deal on a SPAC. So
yeah, that's funny. Yeah, actually, it's kind of an extension to what Key was asking, and this primarily relates to a lot of the tech unicorns that have, over the last 10 years, very consistently raised hundreds of millions of dollars year over year, billions, one could argue, at increasing valuations. Now, do you see the emergence of the SPAC markets and de-SPACing that subsumes a lot of these new companies, perhaps a bit premature in the sense that they probably go public too soon, and therefore they don't really have, because as a public company, the share prices are a lot more volatile as compared to private companies. So how would that affect their ability to kind of go further and raise more capital, like significant amounts of capital, to continue on the growth trajectory? Do you see any issues with that going forward?
Well, I definitely see issues for that going forward. A good friend of mine, has a company worth, about 100. He's raising capital at 150 million, and he was just offered to be SPAC'd at a 3 billion valuation, and he's pre-revenue, and the valuation of the company is 150 million, not 3 billion. So he's a smart enough CEO that he's kind of like, I'm probably better off in the private markets building the company slowly. So it really depends. I mean, if someone, obviously on the other side, there's less dilution, because if he's raising, say 15 million at 150 million versus 300 million at 3 billion, he's got a lot more capital to execute. So he's probably not going to run out of cash anytime soon. So the issue is some of these companies that raise cash prematurely, if they're not, I've seen electric vehicle companies go public and they don't have any customers yet. And that's dangerous, because they might not get any customers. Their technology might not be that good. The company might not be that good. They're certainly not ready to be public on the NASDAQ as a pre-revenue company. So I think you will see a bunch of these companies burn out. And then if the management teams aren't prudent, they might, burn through capital at a faster rate than they would have if they were private and their venture backers and their board was very conservative because they didn't have as much cash. So look, I think a lot of these public SPACs are not going to be around. Probably 3 years from now, there's going to be a fallout, and there could be greater regulatory issues because a lot of them will fail, and they weren't supposed to go public in the first place. They were supposed to be in the private markets, build the company, and a lot of the pre-IPO venture rounds are now going public in SPACs. So I don't think that's a good thing. I think that's very dangerous for the public markets, and retail investors are then piling on, and they don't know anything about, they don't have the sophistication to understand that a company is pre-revenue. They just look at the electric vehicle, and they're buying the stock. So I think ultimately there'll be a fallout in the sector because, companies that aren't ready for going public are public, and they're certainly not ready for it.
Yeah, Candace, I completely concur with you. It also is a bit reminiscent, going back a number of years, when SoftBank's Vision Fund was throwing money around. I have a friend of mine that was offered several $billion, and his comment was, I don't need several $billion. And the answer was, okay, well then I'm going to give it to your competitor. So he took it. And so there is a lot of froth out there.
Yeah, the problem is there's just not a lot of DraftKings. There's not a lot of great targets, as Candace was talking about. So,
well, I think there. Well, I'm sorry. I'll let you finish. I apologize.
Right. I mean, so the reason why these things are going to fall to earth is that if the companies aren't ready to be public and they don't earn money, then there's essentially no arbitrage like an IPO. Of course, these things are going to end up falling to earth. There'll be a few that are shining stars, but I wouldn't bet long the averages.
Yeah, to your point that there aren't a lot of good companies, there actually are a lot of good companies, and a lot of the really good companies with the intelligent management companies are willing to stay private, and that maybe leads.
Right. Well, to finish the sentence, I'm sorry, my mistake. All right, those companies aren't going into SPACs.
Right.
Right. So that's what I meant.
Right.
That's how I wanted to finish it. DraftKings is a good example. There's this one rare earth company that's done well, but if you took an average, it's poor, and it's likely because, as Candace brought up, the average retail investor just hears SPAC and they write a check, and it's a .com waiting to happen. I'm speaking about it tomorrow at the New York Society of CPAs.
Ira, let's and Todd, I have 3 or 4 other speakers and you wanted to also share your perspectives on venture secondaries. We'll do a SPAC focused event again. We did 2. We'll do another one.
No, that's fine.
You want me to put my slides up?
Yeah, go for it.
Okay, I apologize for those of you that were around earlier this morning when we talked about this, but I just want to give an overview of the venture secondaries marketplace. So there's three different types of transactions. First is an LP-led, where the secondary buyer is buying an individual's LP's remaining pro rata interest in a fund from an investor that either needs the liquidity or is strategically determined that they want to reallocate the money elsewhere. Second is GP-led restructurings, where the secondary buyer buys across the entire limited partners base, not just buying an individual LP. It's a structured process across the entire fund, and it allows the GP to restructure and extend the life of the fund. These have been around for a while in the private equity and buyout secondary market, but they're relatively new in the venture capital secondary market. But arguably, they're much better suited because venture capital funds to stay in existence longer, and the best assets don't get realized as quickly. So good assets stay later in a fund's life and make up a disproportionate share of the fund's NAV. So GPs don't want to be forced to sell when funds are coming to the end of their lives. So a restructuring happens. So you're going to see a lot more of these. And then the third is direct secondaries, where the secondary buyer is buying directly from the cap table of the company by buying stakes from current investors. They could be current employees, departed employees, angel investors, early seed investors, and others that want liquidity. So all in all, it's an attractive approach to venture capital investing. You're investing at a discount, which I'll get to. You get more rapid return of cash than early stage investing, and there's opportunity for good multiple appreciation. And also if an investor has money exposed to private equity buyout funds, they're typically a very diversified portfolio of LP fund interest, whereas venture secondaries have different characteristics. So it's a really nice diversifier. Just another comment on GP-led restructurings. It's rare where you find a transaction that's a true win for all of the parties. In these GP-led restructurings, the way it works is that the secondary buyer comes in through the GP, offers a discount to the entire LP investor base. Whoever wants to sell can sell. Whoever wants to stay can stay. And there's also a 50-50 option. You can sell some and keep some. For the LPs that have been in the fund a long period of time, they get liquidity. And for the GP, there's no longer pressure to sell great assets. They can get it extended. And for the new investor coming in, they're coming in at a nice discount. So it's really a nice win-win-win. This is just a chart on the top to show that venture secondaries offer a higher multiple than typical LBO infrastructure and real estate. And the venture secondaries, have eliminated the J curve. So these are two quite attractive aspects. This takes a look at the discounts in the marketplace. And the most interesting thing about this is that you're getting very, very significant discounts for getting venture secondaries, and that's been around for this is going all the way back to 2012. So quite attractive means to get in. And so why is that? Well, first, because venture is much more typical to diligence. Companies, many of them are not profitable. The GPs and the companies don't want to share a lot of granularity. And so the diligence is difficult, especially if you're not an active venture investor in the funds. Secondly, there are transfer restrictions. Many GPs or many LPs are given the right of first refusal if they're an existing investor in the fund, and the GPs have some restrictions. And because of that, there's fewer brokers involved, and so there are fewer buyers. And with a limited buyer universe, it's very, very attractive for those few that are in an appropriate position to make a purchase. Now, I think turning to the market, the key thing here is the upper left-hand box, because you can see that companies are staying private longer. It's 3 years to an IPO for a company back in 2000, and today it's 8 years or more. And with companies staying private longer, there's a lot of money available to continue to keep these companies private longer. And in the upper right-hand box, you can see that at the LP level, GPs are making investments over a 4 or 5 year time period, and this is taking a period of time for those companies to come public, to get to fruition, to get to scale. And so it's amazing that 73% of the private equity and venture capital funds in the marketplace today are 13 or more years in life. So as an LP, you can get really tired and want some liquidity along the way. We see it as a large and growing marketplace. If you take a look at all of the market cap of Series B or greater companies today, it's $1.1 trillion. And if we estimate 5% will have secondary transactions. So in 2021, that's $60 billion just of direct secondary deal flow. And looking out 5 years, we see it's a 3x of that. So this is my last slide. So a combination of direct secondaries plus LP interest deals and GP restructurings, it could be a $70 billion marketplace. And an important point here is that a key issue in venture capital is that venture capital is very relationship driven. And PE and buyout secondaries players don't necessarily have the relationships with the venture GPs that an active venture GP investor would have. And so to pull off some of these venture secondaries transactions, you really need a lot of trust of the organization that you're working with. So I think those few organizations that are active primary investors in GPs are well positioned from a platform standpoint to succeed in the venture secondary space. So that's all I have.
That's a lot and pretty good. Thanks.
If that's all you've got, I'll take it.
Hi, this is Chris Mayo. Just a follow-up question there is, how much activity are you seeing, traditional primary direct investors now becoming competitors in the secondary segment, especially around things like directs where they're doing cleanup trades?
You're seeing those organizations participate, absolutely. But importantly, companies don't necessarily want to share a lot of information, and in order to be in a position to price a deal appropriately, you need to have a good feel for those companies. So if you're an active investor in a GP, and so you're looking at the underlying portfolios in their company and modeling them out, you're in a far better position to be able to make a quick and more accurate price for the deal.
Yeah, no, I was thinking more like a direct investor, like a Sequoia or somebody else, or maybe even an industry coming in where they already have access to a lot of that underlying information as the direct investor, and just buying out other people who, maybe even are existing LPs or investors, but don't have access, to that kind of information.
Yeah, well, so Greenspring is about a $12 billion venture capital firm.
I'm familiar. I know you, when you were modding, you knew all.
And so the Sequoias and the Accels and the Benchmarks, all of those organizations that are active investors in those underlying portfolio companies, they can put more money into those companies, and they can certainly, they've got the information to take money to clean up the cap table. Absolutely.
Okay. I was just wondering how prevalent it's become.
So look,
I don't see a groundswell of activity there, okay. But I think to your point, which is a good point, you can see more of it over time.
So as with a lot of things, we did do a secondaries deep dive in June. Actually, Chris was on that panel. It may be time to revisit. But let me switch gears and ask Ron Diamond. I called on you too early when we transitioned. So everyone just going around sharing their insights, and you've got, a cornucopia of insights. So let me turn to you.
Thank you. First, it's great to be here. I'm very new to this, and I think, Mark, you really put together a really, really good, I don't know if you call it a conference, an ecosystem, but you've done a really good job with this. I guess what I wanted to talk about, look, family offices, and this is my world, my background, I ran a hedge fund, I sold it, and I just started investing. And my thesis was not, basically if I could put in a couple $1 million into a deal, I'm going to be the last 50th call. But if I can get these, they didn't call them family offices when I ran my hedge fund, they call them rich people. So if I get these rich people who are now family office to put 48 or 98 million, 50 million, $100 million is better, I'm going to get a sooner call. So that's basically what we did and how we started. So we represent about 100 families, between 250 million up to 30 billion. But what I found is when I started speaking at these, and I speak at all these conferences, Opal, Camden, Fox, and they're all wonderful conferences. I'm friends with all these people. But the conferences in general have been bastardized because at the end of the day, it's you pay me 25 grand and now you're the expert in accounting. You pay me 25 and you're the cannabis guy. So it's a pay to play, and that's not. So what I'm trying to do is, as I mentioned to a little bit earlier on the call, the reason private equity and venture capital disrupted the public markets is because there was a greater alignment of interest. And it all goes back to alignment of interest. And initially, 2% just cover the overhead, 20% you make money only if I make money only if you make money. That's a better model. But I do think this has been bastardized and it's become an AUM game. And these funds are too big. They're massive. SoftBank can't run a $100 billion venture. You can't place that kind of capital. I know, like in Brandless, for instance, they spent $250 million on Brandless, and Michael Loeb's a good friend of mine, and he was talking to the guy at SoftBank, and he's asked Michael what he thinks it's worth, and Michael said, I think you way overpaid for it, and Michael asked him, he said he thinks it's worth $0. So he said, all right, then why would you pay it? He goes, it's 25 basis points, it's a woman-owned company, and I might be wrong. So that's the thought process, and that's not really how you can run efficiently. So it's my belief, my thesis that as private equity and venture capital disrupted the public markets, that family offices are starting and will ultimately disrupt private equity, venture capital, and real estate. And the reason primarily is because it's got patient capital. So if I'm an entrepreneur or I've got a company, 1,000 times, unless I want to flip the company for the most money from day one, and I don't care about anything else, then it's a venture capital or a private equity firm might be a good way to go. But in many instances, if you're looking to sustain a legacy and keep a company and grow it long term, your interests are much better aligned with a family office. The problem is that they're so fragmented, they're so siloed, and they're very inefficient. So really what we're trying to do at Stanford is to create the first of its kind. And when I say pure, I mean 100% of the people in this program will be family offices. So we've already spoken to the Pritzkers and some of the largest family offices. They want to be part of this because it's going to be pure. This is not to make money. This is basically to create an ecosystem for family offices to get together. One of the things that I found after going to 2 or 3 of these conferences is nobody's going to hear me or anybody really speak. The reason these family offices go to these conferences is to meet other families, period, end of conversation. There might be a couple things that are interesting and topical, but in general, they want to meet. So we want to create that ecosystem. So for family offices, they need to professionalize and institutionalize. 95% of them need that help, right? Because the whole model right now is flawed. 25% of family offices make it to 2nd generation, 10 to make it to 3rd, 5 make it to 4th. So the model doesn't work. So we can help with that. And then with the bigger family offices that already are institutionalized, like the Pritzkers, the Crown, Bloomberg, Dell, Sergey Brin, then what we could do is we could create an ecosystem where it's a networking and they could share deal flow. Nobody's trying to sell them anything. They're not saying they're a family office and then trying to pitch them a hedge fund 10 minutes later. And it's a trusted environment. So that's really what we're trying to do. And what was interesting is we haven't even done a public announcement. We haven't even done a press release on this yet. All we've done is I just put something out on LinkedIn. And once I put this out on LinkedIn, I'm getting cold called from, we represent about 100 families, but probably 30 of the largest family offices, 25 of which we don't represent. These family offices don't cold call people. They don't cold call me. They just wanted to see what is this all about. In addition, you're also seeing the sponsors, the big companies like Denton's and BDO and DLA Piper, they want to be involved in this. So what I'm trying to do is keep it pure, 100% family offices. There will be no service providers as part of this. And we will have, if we can get 200 people at Stanford to do this, DLA would love to sponsor this. Kirkland would love to sponsor this. I mean, any of these firms would love to sponsor this. what we have to do in my job, and we're going to launch the first one's going to be in the end of June, is to keep it pure. And that's not hard. And I've already formed a committee. I've got an advisory board. So Paul Carbone from the Pritzker family office is on my advisory board. Scott Earthy from the Bechtel family office is on my advisory board. Dan Drexler from the Crown family office is on my advisory board. So together we know who's real, what's not. And that's what we're trying to do. We're trying to take a $10 trillion inefficient, fragmented, siloed industry, which is the better way to do business, in my opinion, and professionalize and institutionalize. So that's what we're trying to do.
And we get some kind of most favored nations for some of our best families, right? Right, Ron?
Of course.
Any questions to Ron about his thoughts on private equity versus family offices or the Stanford initiative? I will say that one of his
I've got one question.
Yeah, go Akshay.
Hi, Ron. So my question really is, I see a lot of family offices that I work with, and they're all trying to kind of get more, as they evolve from generation to generation, they're trying to be more and more direct, as opposed to, paying very fat fees to large managers. And in certain cases, it's warranted, but in a lot of cases, it's purely a network and relationship-driven game. And the family offices are trying to kind of go around that. So is that what you're seeing happening? Do you think that's going to be the future, where all of these deal making is going to be fairly transparent and potentially disintermediated, in the sense that there's no more VC funds or PE funds?
No, family offices will never get rid of private equity or venture capital. These are massive industries that will continue to stay massive. I just think family offices will slowly chip away. The issue with the question about direct deals, what was interesting is most of the families who wanted to do direct deals, the rationale was flawed. You don't do a direct deal because you want to save money on fees. You do a direct deal because you like the deal. So they were doing it because they don't want to pay fees. Now, if you look at it from the perspective of from 2008 until right before the pandemic start, pretty much everything went up. If you invest in venture capital, private equity, real estate, stock market, most things went up. So these family offices that did these direct deals for the purpose of saving money, they worked. But the problem is it's a lot more complicated. And as we go into a bit of a recession, which we're going into, how deep we don't know, these direct deals aren't going to be so easy. And most of the people in these family offices, who's the CIO? In many, not all, but many of the family offices, it's the guy who was the chief financial officer for their operating company. They're two totally different skill sets. So what I think is going to happen is, as we go into a bit of a recession, more and more of these direct deals are going to get hurt, are going to go down. These families are not going to be able to deal with it, take it, and they're going to come back to investing in the funds. That's how I think it's going to play out. I think that it was just a perfect storm where everything worked, everything was up, and the biggest issue, the biggest obstacle most of these family offices have to doing well is the ego of the patriarch or matriarch.
Yep. Well, and a lot of them are not well stewarded deals. They're like these club deals, and someone needs to lead, and very few families have the third party capital stewardship. But they are the smarter ones in the room. So if you could just marry them up, which is what we're basically trying.
And they also look at it from the lens of, if I'm a bright kid and I come out of Wharton, and Apollo hires me, they're going to pay me $500,000. They look at me and say, "I'm paying you 500 grand. I think you can make me 10 million." That's kind of what's how they look at it. A family office right now, again, in general, I'm saying most of them, they look at me as a $500,000 cost. And until that changes and shifts, the family offices aren't going to be able to really effectively compete with the Apollos or the Carlyles. So there's a whole bunch of things that have to shift, but it's starting to. There is the capital. And everybody's starting a family office division. Every bank is starting a family office division. Every brokerage firm has a family office division. All the law firms. And I talk to them, and I'm like, "What is this?" They're like, "It's optics," but it is what it is.
So we are going to have a whole event around you, as we have here on the screen, Ron. And there are two things I want to point out on the screen. One is our first in-person event that we plan on November 16, 18. It's our 4th annual New York, and we are going to have parallel venues and hybrid. I'm very excited about it. Sort of what I wanted to do with my alumni connecting and bringing it all together finally. Silver lining, and then you are going to be moderating a sort of this whole topic, right? And bringing in a really interesting panel of those who would represent this. And perfect segue to Rich Sobel, who has basically, I call him the father of private equity in Eastern Europe or Russia. And he's been a principal of a family office. And now he's really blending these two worlds together with Eddie Vonderpart. And I think they've done 5 or 6 of the deals that we brought here on the platform. So Rich, you should be on that panel with Ron in some ways. And you're from Stanford, even better. So
I was rejected from Stanford.
So was I. So proud of it.
Thank you for that nice introduction. And I know it's late, so it's kind of like at the end of the day, trying to keep people's attention. And look, Ron is a very hard guy to follow because I agree with just about everything he said. And I live that being inside a family office, having been a deal guy, I know how it can be quite dysfunctional to get proper decisions being made. And it takes a while. And the mentality of being a successful general manager, owner, operator is very much an antithesis to being an effective capital allocator or deal doer. And those things, they kind of directly compete or conflict. I'm in Russia. It's cold here. We've had the coldest winter in a while. And I've had the Russian vaccine and it works just fine. My perspective is that, we're in the beginning of a new commodity cycle. So the Russian market is living through 2 things pulling in different directions. One is they're about to have new sanctions layered on them, and it's kind of creating some downward pressure. And the other is they're getting this uplift from commodities. I am shifting myself back to the United States. So I'm also, as Mark alluded, shifting so that I'll spend much less time, eventually practically no time managing the family office and more time doing deals, because we're quite convinced that this is going to be a good vintage. And all of the talk about sustainability and cannabis really is real for us. And I'll just pick up on a few of the comments that I agree with that came earlier. Eddie and I have gotten to know each other through this wonderful platform that Mark has set up that you all participate in. And we've managed to find, I think it's now 5 deals in the last 9 months, and they've all worked out reasonably well or extremely well. And it's a big thanks to many of you, because some of our pipeline and some of the deals are directly sourced from people on the call today. And I think it's really a powerful statement about what putting this kind of group of people together, where there's a lot of domain expertise, there's a lot of connectivity, and people are sharing. And we specifically are interested in ag tech, clean tech, ed tech, health and wellness, and fintech, and cannabis. But actually, they're not all equal for us. The roots of our business come out of ag tech. And while we didn't start looking for ag tech, all of a sudden we've got a basket of really interesting deals. And one thanks to Ron in vertical farming. And we've been very pleased by the receptivity that we've been able to get, finding our way into interesting deals, even though we're just in the process of pushing the boat out. So I'm saying this not to kind of pat ourselves on the shoulder, but to give many of you who are in the same mindset a little bit of, validation and reassurance that you can do it too, but you can't do it on your own. We can't do this without benefiting from the expert network on this phone and through this network. And the first thanks goes to Mark for his kind of consistent support. And I do believe that you have to be more than a generalist. And so in the sectors that we're focused on, we have identified some early emerging managers that we work closely with. In some cases, we've provided some capital to them. In other cases, we've solicited people to work with us as venture partners. So we try to be able to articulate how we can bring value to the companies and be patient capital. And so I think that this is really just an extension of what Ron has been saying, is that when family offices look out and they say, I could give money to Blackstone, I could give money to Goldman, I could give money to Sequoia, I'd be tied up in these funds. I want to be more involved. And so what we've tried to do is identify a degree of focus in the sectors, and cannabis is another one. Thanks to Eric, we found our way into a really great deal. And now we've got a basket of other interesting cannabis deals. So these types of things allow us to prospect for deals and offer co-investment. And really, it's a club model. So, you know, there's going to be opportunities for us to work with many of you on the phone. So I just want to reiterate, and you know, it's late. It's probably better if we open this up for questions. But the idea of
Rich, it's only late where you are.
Okay, well,
I know.
you know, the idea is to really come up with a model that doesn't completely disrupt, but that does essentially take into perspective the unique, how to say, preferences of family offices, which is that they don't want to be purely patient capital. Passive capital. They want to have a relationship with the platform. So really what we're setting up is a bit of a club. It's not just US centric, it's US and Europe. And just, you know, for instance, thanks to Akshay for a recent deal that he introduced us to. I'm probably missing a few others, but thanks for Eddie for throwing his hat in and becoming my partner. So I'll stop there.
So they're doing what I really want to do, but I need to play my role, bring everyone together, is they are not pigeonholing themselves into private equity, credit, venture, but they're marrying opportunism of family offices with institutional discipline. And it's a great pocket I think everybody can participate with going forward.
Mark, let me say one last thing. I'm sorry, because I'm sitting here thinking, look, in the small private equity deals, that part of the US economy, probably Europe too, but US is a little bit closer for me, is brutally affected by coronavirus. There are a lot of good companies that have terrible balance sheets with motivated management teams that want to get off the mat. And so our sense is in this small PE, the money isn't really finding it. It's much more inefficient. And what we're looking for as criteria number one is a great manager that has a plan to rebuild the business. So we're really not interested in just buying something cheap. We're looking to back great managers that have a viable plan to build a platform. So, I mean, why am I saying this? Because I think it probably resonates for many of you. And if you have a deal or if you're interested in talking with us, we'd love to talk more. But, you know, we're struggling to come up with the right name. But part of me thinks that this is like the birth by 361 private equity. So anyway, this has really been motivated by conversations with many of you. Thank you.
If you can come up with a name, you get a point in the GP. Maybe not. Anyways, but it's been a pleasure working with Rich so long. But you know, we're now transitioning in some respects, but we don't have to. We can do whatever we want. But at 12, there is an Outlook call happening where we're going to split off into some rooms. We're not a huge group. You know, if you look, I'm just going to show you. I'm going to open up the rooms, just so you can, if we wanted to move on to it. But I've really enjoyed this session. I know it is getting late for you, Rich, but for us, it's you know, anytime you go after 2 hours, it is, well, for some of us have been only for 1 hour, but some we've been at it for 2.5 hours. But I welcome anyone's thoughts on their best ideas, or we can go into these rooms. As you'll see, we do these every Wednesday. All those rooms that you'll see, there's a cannabis room, there's esports, education, and actually I'm going to close them because I need to give you all the ability to move around if you wanted to. But again, we don't have to necessarily go into those rooms. Tomorrow, we are having a session to talk about Asia. I think a lot of people are trying to access Asia and their portfolio construction, and that we should have an opportunity to compare notes with those who were there. That's this. But Joe Azar, are you on? I think you may have moved on to the other. We have a 12 o'clock with the ARS, but I'll stick around here with you guys. What do people want to do as we think about other events other than, you know, that this calendar, or other subjects you want to discuss?
Hey, Mark.
Yep. you're on.
I will, if anybody on the call is interested in learning more about the Stanford Family Office Initiative, you could just email me or just email Mark, and Mark will just forward it to me. And I'm happy to, we're going to launch the first one in June. It'll be 2 3-day virtual conferences, but it will be like nothing else in the market. So if you're a single family office, just message me if you're interested.
Great.
Do we have anything, Mark, do we have anything coming up with regard to mental health?
So it's up to, as usual, whoever, if you want to champion that, we'll, as you know, this is how we do it. In process, I think we continue to support that from different fronts, both from the philanthropic side and the investment side. Did you?
Yeah, because I would, as you know, coming out of the COVID crisis.
Right here, Kim Colt is the person you want to talk to. She's investing in tons of mental health venture. It comes from everybody's heritage, right? That's part of her heritage.
4 good ventures.
So yes, in an indirect way through the VC, but let's get it back on the calendar.
Mark, do you want to talk about Top Shot? I don't know if you know about Top Shot.
Teach us about Top Shot.
So
your unique insight moment. Go.
I want to talk about it.
Yeah, you want to, Jim? Look, I always am. Clubhouse has been a cool conversation about this. I've had like a 3-day panel on NFTs, and I get tired. But Jim, if you want to talk about it, I'm more than happy to talk about it.
Well, Jonah, as usual, you're going to do a much better job of explaining what this is, because it's really focused around your demographic. And in fact, I just defer to you. But basically, this is a way to it's a blockchain model based on what I would loosely call the baseball trading card of old. And instead of physical trading cards, they are monetizing a model where you're purchasing a video, a moment in time from a live sporting event. And it's really an interesting play on ways for fans to become more involved and invest in their favorite players and teams in a way that kind of transcends every other kind of investment vehicle or fan involvement platform that's ever been. So Jonah, I think you're probably better to speak to the technology part of it and the,
I'll briefly summarize just what NFTs are. The acronym is non-fungible tokens. The best way I can explain that in a crypto sense, it's not a currency, but it's like a very, very intricate receipt of purchase for a digital item. So the best example I could give is, imagine if they were selling a digital 1-of-1 of the Mona Lisa. You could either buy the whole thing, or you could buy fractions of that painting, being the NFT, and you share in the ownership of that painting. And if it ever transfers, or if it goes to another museum, you get what's called, royalties on that NFT, which is very interesting. So the idea for Top Shot is, if you own a LeBron James card, and it's like a 1-of-1 rare LeBron James memory card, what's very interesting for the athletes is they're getting royalties whenever those cards are traded. So if I own a LeBron James gold card, I can then sell it to my buddy Jim for whatever the secondary market rate is, and LeBron James is getting a cut of that, and so is Top Shot. But the idea is, it's a really interesting way, a decentralized way of sharing assets, which is new.
So you see this analog playing out in different ways, or is there a way to invest in this, or what's the?
Well, right now, I talked to several lawyers on the platform who, some of them love it and some of them are like, oh my God, this is a rights management nightmare. But the reality is the genie's out of the bottle. So this is going to be, it's like GameStop. Now that it happened once, it'll probably happen again. Right now, it's iffy to invest in. Top Shot is different because it's facilitated in a very appropriate way. There are platforms like Nifty Gateway where you can buy art installations and art pieces. But what I see happening is there'll be future sports teams, future entities that may release NFTs that you could buy shares of that work like a Patreon. So if you don't know what Patreon is, you give money directly to the business or the creator, and they give you something in return that makes you feel special. So the idea is it's like a very well-enhanced Patreon that allows businesses to connect with their customers in a way that they haven't before. And a blockchain is tracking that loyalty and feedback. Really interesting stuff. So I know some people in the NFT space that are experts. If I can get them together, I'd like to have a panel to explain NFTs more, because it is cryptocurrency, but it's a different economic model for cryptocurrency.
Yeah, for one thing, the optics are better, the transparency is much better. So there's a full platform out for price discovery. You can see the entire series of these things. There are several different flavors from with scarcity elements. So, you know, they put out these things called packs, and the packs drop, and they give you a little notice about when the packs are going to drop. Very recently, the packs are wildly oversubscribed. I mean, like, you know, 26,000 people for 1,000 packs. And you basically get in line for these things. And once you've purchased them, and I purchased one, not without any, you know, kind of comic flair here, I couldn't even get on the platform last night to look at the ones that I've purchased.
Yeah, you should see what it's valued at. My buddy was able to check his this morning. He bought for $1,400. His card is now worth $30,000.
Oh, it's a different kind of commodity. Dominic, are you seeing that play out in your world? Dominic,
Sorry, this is Paul Cohn. My son's in the music industry, and he said, I don't know what platform, but this is happening in the music industry too, where you're selling the fractional. He said you could sell like a snare drum beat for a song, or
yeah, the idea is that instead of like going through a record label, you could sell direct to consumers, and they can buy like royalty rights in the song by buying the NFT. So basically they're funding the creator, and then the future value is that they're getting royalties if that song's used, because they are essentially the record label, just very decentralized, and they don't have any management over it. All they're doing is buying that asset and expecting royalties, or buying that and expecting that at some point that song is going to be viral, and they can sell those rights to another person for, you know, gains. Very interesting. What I think is going to happen is you'll have secondary markets for all sorts of different assets.
And everything doesn't make sense at all. For example, you know, there'll be a series of these things, the same moment, they call them moments. The same moment there'll be 10,000 of them. And it has all these nuance. So for one thing, the value changes from one part of the series to another. The jersey number, for example, is like always very valuable. For some reason, 420 is very valuable. Number 420.
And look, I don't want to go too far down. This sounds like a rabbit hole we want to go down. Let's just pause it there, unless other people want to comment on it. I know, Todd, you were doing some music discovery, talent discovery. I don't know if this plays into that, or you have.
You guys can check out two websites. One is called lum.fm, and another one is hitlab, hitlab.com. And I could talk to you about both of them. I'm very actively involved.
Sure. I think the goal that I wanted to push here is that we are entering a new phase of cryptocurrency and a new financial model for owning various assets. And I think we need to talk about that on this platform. I know I'm friends with a CEO of a fantasy esports company that's going to turn his fantasy esports properties into NFTs. I could probably bring him on, and several other people I know, but it's very new. We don't know what it's going to look like in the future, and it could be important.
Yeah, interesting.
Let's do it.
You know, you mentioned rights management that is clearly intellectual property rights management, which is clearly critical in all this. There's another company that I'm an investor in and an advisor to. It's called Molten, M-O-L-T-E-N. Gosh, I forget the website. I think it's .co, but you can find it. But that's exactly, you know, we're doing it primarily in the film industry, but moving into music as well.
Yeah, I think that's going to be very interesting. I was wondering why. I actually asked a big Hollywood lawyer who was on this Clubhouse platform because he's involved in legal tech funds, why they wouldn't look at NFTs to initiate certain contracts. And he said, well, we very well may actually look at that. It's just so new. But now legal tech funds are looking at it because it may be another way to provide management on contracts because they're very good receipts. So we'll just see how it plays out.
Yes, and I'm looking at two projects where people are doing basically the same. One is a traditional exchange, also digital tokens, but it is not a cryptocurrency. It's basically DLT, where people, owners of any intellectual property, it can be a sports team, it can be a painting, it can basically sell it as a token and then start trading it, and there are no market makers. It's basically open market of this type of tokens. And the second thing is they're about to launch, and they're trying to launch in many countries, and I'm discussing fundraising opportunity with them. And the second one is another startup where people develop the digital autographs, and they're trying to bring them to the market and start selling. So in essence, it is a synergetic proposition where you can bring these autographs to the same audience, which trades rights and royalties of these actors, actresses, and musicians. So there are many players in the space.
For me, where I'm most interested is I want to own the platform where you have to sell on. So like the Nifty Gateways, OpenSea, I would like to be the holder of the platform where you're buying and selling these secondary assets. I will say that people like Coinbase and Gemini have realized the value. Gemini already bought up Nifty Gateway, but I wonder going down the line a few years from now, there'll be another platform that could be ripe for opportunity.
We have a few Coinbase people just joined, thanks to Bill Deutler.
Yeah, it's really interesting. I feel like I know a lot, but even I'm learning because it's changing every day. Half of Clubhouse, when they talk about NFTs, are like big artists and DJs like Diplo and Monster Cat and big DJs who are looking to democratize their music rights. So I think we're going to see that trend follow for probably a lot of these other assets in entertainment.
Fair enough. Others? So on that one, let's make sure that we'll add it to the calendar. I know you know how to put these events together, so we'll just turn you loose. Maybe you can team up with Jim.
Yeah, I can look at doing that. I have to ask my contacts if they want to do it, but I don't see why they wouldn't. This is something that really interests them.
Particularly anyone else? I'm seeing Charles. You're new for me, at least. I mean,
yes, thank you. It was a really fascinating time to be with you guys today. Just curious if anybody, in light of Texas, has interest in participating in the purchase of one or more utilities. So there may not be an interest in this group, but I'm always curious because I'm working with some people who are in the process of doing that.
I was with a family office that invested and ran utilities. What power source, or just in general?
Well, it's a collection. The problem set is looking at the grid, microgrid interface with everything like car chargers, and so they're looking at a utility that can do both. They can do microgrids as well as the standard utility. We're leading with a key person who just ran the largest utility in the country, retired, but he likes the cause of trying to fix some of the grid problems, such as what Texas.
Who is he? Who is that person? Is he with Progress or ex-Duke?
No, former PJM.
Okay.
Senior executive. Terry Boston is the guy's name, so I don't think he minds my sharing it. But the reason he's interested is there's a group of companies that are trying to solve a problem for the Department of Energy, where they've just admitted in a report that came out of NREL this past November that what you saw in Texas is going to become a new normal. That the grid and microgrid or distributed generation interface is going to not only make it difficult for people to get some of that energy to market financially, but they're creating electromagnetic accidents on their grid. which is going to happen more frequently. And so they're almost predicting that the grid will collapse much more frequently, and they're trying to figure out just how to pick the pieces up quicker. But anyway, that's what's behind it.
So I guess two things come up. One is I just flashed on the screen. If you have deals, you can, of course, old-fashioned, just email me. But because I'm in a broker-dealer environment, I have to go through a process. So I'm trying to at least advance the process. Those who sign indemnities can get into the. I was told not to have no one wants to be a big girl, so I've got the big person room, and we'll take it from there. And then there's the formal part, which we don't have to be. We can be part of a syndicate, or we can just curate the helpful introductions and not be part of the deal. But we're trying to then take this, and I'll just show you one thing that happened is this sheet here. You can see it just yesterday. All these deals have been onboarded, and you all can have at this sheet, and I have all the rest of the information. So this is one part where we're trying to feed the deal dragons or facilitate relationships. So if you had a deal, you would go to onboard, O&B, which if you just go to 361 onboard, you'll see deals, funds, advisors, and we're adding philanthropies. But happy to look at it. Then it makes it easier for me to be able to help curate if you go to that O&B. Put as much or little as you want, just no names, because then it also goes into the app. So if you go into the app, you look at our home, you'll see a lot of deals that once they've been onboarded, it comes through this flow. And there are these tags. So if you see something well, that's probably not a good example, but let's say it was a tag that, I think you guys get the point, but all the fintech type deals or people who put fintech in their profiles will come together. Not a great demo of my app when I can't get my hashtags, but you get the gist, I hope.
Sure, I appreciate it. Thanks a lot. And this is early. This is very early on. There's not even a deal sheet yet. They're just pulling the pieces together, like the management team, the prospective targets to acquire.
Okay.
But it might happen pretty soon.
Yeah, Charles, I'd be interested in maybe taking a look at that. So we've invested in independent power down there and have some good connectivity into Texas.
All right, and we're open to
Senator Smith.
Yeah.
Great. I'm going to give you my email in the chat if I can do this right, so that you'll know who I am. There won't be no secret here.
Great. Are you on our app, Charles?
No, I'm brand new to the crew. I just been somebody said, you got to see these guys. And I said, okay. So I just fit you in between meetings, and I was on for a half hour and dropped off for a call and then got on again. So. Okay.
Well, yeah, happy to, that we can get together at some point.
Yeah, be glad to give you my background. I mean, years ago, I used to develop a due diligence service for Gartner Group in New York. And then
oh, you know the Kutniks?
Yeah. Dale was there.
Torrin's often here. He was on earlier, the family office.
Well, that's cool. I haven't talked with him in a long time. He'll remember me because we used to work down the hall from each other.
Well, here's Torrin here, as you can see.
Oh yeah, just like that.
So the whole idea is that we're sort of we're a community, and the other thing I'm going to be introducing is actually Jim Hawk. You want to table the idea of what we're talking about, bringing on this sort of a welcoming, mentoring, vetting type of curating committee?
Yeah, well, the basic premise is that we just put together a group of people to really meaningfully help new people coming onto the platform, regardless of the capacity in which they're coming on. So they might be a CXO, strategic advisor, or family office, or other kind of investor, or thought leader, or regardless of what the case might be. And we're trying to figure out better ways to help them understand what the value is on both sides of the equation, both for for the new member and for the community and for, 361 also to a lesser extent.
Wow, this is cool. Yeah, I love networking like that. I do it in different areas, and that's why we've had a good measure of success. We'll talk, offline to whoever wants to do it. I am on LinkedIn. If anybody needs to hunt me down that way, I'm a pretty open book. But these deals that I'm doing are a little bit under the radar.
That's what we like. We now almost have 700 people on the app, which is great.
And so if I just hunt down the
36, it's either iOS or Android. Look up 361 Firm, or we'll put in the chat
to make it easier, so I don't go to the wrong place, because there's probably somebody who's not as nice as you liking to co-opt your stuff.
Well, they cannot.
I'm in the DC area. What do you expect? I'm a little.
They can't get to the confidential bits, but we do have a public site, and which you actually also need authorization. But I'll authorize you, as I know who's accessing it.
Great. Oh, I see it in the app now. I'll just save the chat. Thanks.
Sure. Anything else for the good and welfare? Well, if not, we have tomorrow a day 2 with an Asia bent, and you'll see many more people. Well, I say Asia, but it's really ex-US. That will be. You'll have, Ahmed is in London doing business really globally, and including has this deal Todd, you mentioned Vietnam.
Yeah, very interesting.
Rob's got some great connectivity as well. He's in Singapore. Zach is in Dubai. Doug's in Hong Kong. Hans Joachim was the head of Arthur Anderson for Russia and CIS. Spent the last 10 years in Africa. Jeff's in Korea. Mark Shmulevich is in Singapore. And then all the people that they're bringing in. So continuation of what we did this morning, but with an Asia focus. Well, I keep saying Asia to accommodate time zones Asia. Hi, Greg. I haven't seen you. You just popped on.
No, I was here. Just without the camera.
Okay. You have a parting comment for us?
No. I was just contemplating how much of everything that's going on I don't know. So.
You sound like Plato or Socrates.
I was going to ask you, has the link for tomorrow been circulated? Or is it the same one as today? Or
it's always the same channel for a while.
Okay, perfect.
Here.
Yeah.
And anyone else? Great that you could join Candace. Jonah, Jim will do that event that we discussed. Bill, it sounds like we might want to do that virus 5 sooner than May, but I'll leave it to you. And Charles, you're welcome to the community. And is anyone else I haven't met? I think if not, I will say adieu, and thank you, everybody. We'll see you tomorrow, hopefully, and be in touch.
Thanks so much.
Very good. Thanks all.
Thank you.
Good work, Mark.
Good job. Good show.
Well, thanks to you guys.